The biggest lie circulated in financial circles is that you must be busy. You believe this lie. The world has conditioned you. Society equates activity with virtue. The frantic man is lauded. The quiet man is often dismissed. You believe the market requires constant movement. You believe your capital must be perpetually active, perpetually manipulated, perpetually doing something. This is fundamentally wrong. The market is not the world. The market is a machine designed to transfer wealth from the active, impatient, and busy to the calm, strategic, and inactive. If you are not financially prepared, and more importantly, psychologically prepared, to sit on your hands for weeks, for months even, you will inevitably pay the market just to satisfy that visceral, animal need for action. You will pay the market to entertain you. I learned this truth early. I learned it brutally. I learned that the hardest, most profitable transaction I ever made was the position I deliberately, consciously refused to take. The single greatest trade I ever mastered was the discipline of absolute, immovable inactivity. Most speculators are not destroyed by bad luck. They are destroyed by the psychological torture of sitting still. They cannot tolerate the silence. They cannot endure the wait. They are undone by their own internal restlessness. You must stop trading merely for the sake of trading. You must divorce the concept of progress from the concept of perpetual motion. Stop the busy work, start the real work. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. Your success in the speculative endeavor is wholly dependent upon the principle of alignment. You must accept this. True trading success only arrives when the market confirms the path of least resistance. You're not hired to move the market. You are hired to follow it. Waiting is the critical process. It is the observation period required to determine exactly where that line of least resistance lies. It is the time you dedicate to allowing the market to expose its intentions. When the intentions are exposed, the action becomes easy. If the market appears confusing, if the tape is choppy, if the prices are ambiguous, this is not a challenge for your cleverness. This is a command for your inaction. Inaction is the correct, high-probability decision during periods of ambiguity. The amateur attempts to decipher chaos. He believes he possesses the unique ability to predict which way the confused price action will resolve. He attempts to impose his will upon the tape. I assure you, the tape cares nothing for your will. It is sheer arrogance to force a position when the market itself lacks conviction. When the great movements cease, when the price action becomes a jittering horizontal line, that market is signaling it requires time. It requires accumulation or distribution. It requires a new catalyst. It requires your absence. You must wait for that confirmation. You must see the great steamship turn its course and hold it. Then, and only then, do you board. If you jump onto a vessel that is rocking side to side, you risk being sickened and thrown overboard. The market is not a place for seasickness. The speculator who constantly searches for an entry, even when the market is indecisive, is revealing a critical lack of patience. He is revealing a desperation for action that supersedes the necessity of profit. He is confusing motion with opportunity. The market does not reward hustle. It rewards clarity. If you do not see clarity, you must remain inert. You must remain cold. You must remain perfectly unengaged. The market owes you nothing. It will not create an opportunity just because you showed up that morning. When conditions are not right, your cash is your sanctuary. It is your ultimate reserved position. Hold it. Defend it. Wait for the market to salute you, to clarify the trend, and to invite you into the trade on its terms, not yours. This discipline of waiting for alignment prevents the most common form of capital erosion. It saves you from the 1,000 tiny cuts administered during confusing times. You must understand the psychological itch. You must feel the profound, corrosive need to perpetually monitor and manipulate your capital. This is the cost of perpetual motion. The discipline of inactivity that Livermore mastered was not cheaply acquired. His greatest lessons were etched through devastating market setbacks, the equivalent of an exorbitant instructional fee paid directly to the ticker tape. Fortunately, this entire financial curriculum was captured by Edwin Lefebvre in 1923, resulting in Reminiscences of a Stock Operator. It is the essential text, allowing us to walk the floor alongside Jesse Livermore, experiencing his massive wins and catastrophic losses in the controlled environment of a printed page. By absorbing the expensive wisdom imparted by Larry Livingston vicariously, the serious trader gains the necessary perspective before risking real capital. However, since the language and technical mechanisms of the 20s differ greatly from today, the modern commentary provided by the Max Davidson Annotated edition is crucial, translating those timeless principles into actionable knowledge for the contemporary market. A link to this essential edition is provided in the description below. The human brain abhors a vacuum. When you have capital designated for speculation, and the market is open, your mind insists that the capital must be doing its work. The idle cash feels wasted. The open day feels like a lost opportunity. This is where the amateur commits financial suicide. He takes small, insignificant positions. He believes he is simply tinkering or keeping his hand in. He believes that these small gambles cannot hurt him much, but they do hurt him. Small, constant losses accumulate with devastating rapidity. They are triggered by a singular factor: boredom. We call this entertainment trading. You are paying the market an admission fee simply to watch the price action. You pay the fee because you cannot bear the stillness of the waiting room. Livermore I learned that I should never, ever trade for entertainment. If you find yourself opening the account, looking at the tape and saying, "Well, there's no clear signal, but I'll take 100 shares just to see what happens," you have ceased being a speculator. You have become a petty gambler seeking a dopamine rush. Your goal is not to trade every day. That is the mentality of a clerk seeking a daily wage. Your goal is to trade only when the odds are overwhelmingly stacked in your favor. Your goal is the infrequent, high-impact profit. Daily activity is the enemy of concentration. It fragments your attention. It consumes your margin through commissions and slippage. It forces you to worry about trivial movements, diverting your focus from the major movements that generate real fortunes. A true speculator saves his best shots for the biggest game. He does not waste his ammunition firing at squirrels. The man who must trade every day is addicted to the noise of the ticker. He cannot stand the silence of true observation. He cannot tolerate the lack of excitement. You must cultivate an indifference to daily market noise. Your capital should remain dormant until a seismic opportunity arises. If you are suffering small, constant losses, look at the cause. It is almost always impatience driven by that psychological itch. You traded a wish, not a signal. You traded the clock, not the condition. The greatest defense against this perpetual motion is the absolute commitment to observation as active work. Inactivity does not mean idleness. It means highly focused mental labor. While you are waiting for the clear signals, while you are sitting on your hands and preserving your capital, you must be intensely engaged in the business of study. The market is testing your character. It is also testing your preparation. You must not merely stare at the tape, hoping for something to happen. That is simply anxious waiting. True observation involves refining your signals. You must review the major movements in market leaders. You must be charting the general conditions. You must be confirming or disproving your initial hypotheses about the market's probable direction once the confusing phase resolves. You are mentally sketching trade scenarios. You are identifying the exact points of entry, the pivot points, where you will deploy your capital. You are pre-calculating the stop-loss thresholds. You are determining your capital allocation. This mental trade, this preparation phase conducted during the wait, is the single greatest determinant of the success of your actual execution. When the signal finally arrives, the amateur is surprised and rushes. The disciplined speculator is ready. He moves with the detached precision of a machine because the entire operation has been run through his mind 100 times during the waiting period. The time of inactivity is your time to sharpen the knife. It is your time to read the character of the dominant pool of stocks. It is your time to study the behavior of the leading groups, the strongest companies, to see which stocks refuse to break even when the general market sentiment is weak. This intense, focused, deliberate study prevents you from becoming emotionally involved when the price finally breaks. Your waiting is not passive. It is the difference between a hunter hiding in the brush, studying the game trail, and a clerk pacing his floor, wishing for the day to end. Master the waiting room. Turn it into your war room. The fact is, success in speculation is defined by the 90-10 rule of market participation. This rule dictates that successful trading is characterized by 90% waiting, analyzing and preserving capital, and only 10% decisive action. The amateur believes this ratio should be reversed. He believes 90% action and 10% research is the key to profit. This is the difference between a high-frequency gambler and a seasoned speculator. The vast majority of enduring compounding profits are made in those small, concentrated windows of genuine opportunity. These windows follow extended periods of patient observation and capital preservation. Think of the market as a vast, arid landscape. Opportunity does not grow everywhere. It springs up violently in short, powerful bursts following the great rains. The rest of the time, the land is barren. The amateur tries to farm the barren land every day. He scrapes a tiny existence and spends all his energy doing it. The master speculator knows the rainfall schedule. He waits. He conserves his strength. When the rain comes, he deploys maximum effort and harvests the field clean. If you find that you are active 50% of the time, I can tell you with certainty that you are trading noise, not trend. You are generating friction. You are paying the commission house, not collecting profit. The true speculator knows that the market's primary function is to waste the time and capital of the impatient. You must ruthlessly cut down your trading frequency. If you are making more than a few meaningful trades a month, you are likely overtrading. If you are making meaningful profits on most of those, you are an anomaly, and the market will soon correct your optimism. The great movements take time to develop. They take time to confirm. They take time to pay out. Your job is to identify the beginning of that movement and stay committed to it without interference, and certainly without constantly seeking new movements elsewhere. In the long periods of market confusion or high uncertainty, your primary duty is capital preservation during the intermission. I do not merely mean the preservation of money. I mean the preservation of mental capital. Money is ammunition. You do not waste ammunition on skirmishes if you are saving up for the decisive battle. When the market is unclear, every day you avoid an unnecessary loss is a day you strengthen your foundation. An unnecessary loss does two things. First, it costs you tangible dollars that cannot be deployed when the genuine opportunity arrives. Second, it costs you psychological fortitude. The man who has suffered 3 or 4 trivial, unnecessary losses during a choppy market is weakened. His confidence is eroded. He begins to doubt his signals. When the real move finally comes, he is either timid with his capital or too psychologically battered to take the position at all. He has spent his reserves, both monetary and emotional, on the intermission. You must view the intermission as a mandatory rest period. Do not allow the general excitement of the crowd to pull you in. The market is always open, but your involvement doesn't have to be. In fact, your involvement should be highly restricted. The speculator who is not currently engaged in a highly convicted position should treat his mind as completely disengaged from the financial machinery. He should be studying, resting, living. He should not be monitoring the fluctuations of the tape like a nervous amateur. The greatest discipline is to recognize when conditions are not conducive to profit and to simply walk away. Close the account, shut the door, and spend the time on something productive, like studying history or charting the major economic forces at play. If you are not making money, at least do not lose your courage. The preservation of your courage is the preservation of your future profits. When you refuse to engage in a low-probability trade, you are doing more than saving money. You are affirming your confidence in your own system. You are strengthening the musculature of your patience. You must remember, the wait is not a static concept. There is also the critical second wait, waiting for the payoff, which is the necessary discipline of sitting tight. This is where the discipline of inactivity must be applied to maximizing your exit, not just avoiding your entry. Many speculators survive the first wait, the tedious period before they find a favorable entry point. But they fail miserably at the second, more stressful wait. Once you have identified a genuine trend, once you are in the market with a profitable position, the greatest danger is not usually the market turning against you immediately. The greatest danger is your own impatience. The amateur gets nervous with paper profit. He sees a percentage gain, 10 points, 20 points, and he fears that the profit will vanish. He snatches the money quickly. He sells his winning position to secure a small, immediate reward. He has succeeded in cutting off the growth of his potential fortune. Speculators who achieve monumental success do not do so by harvesting small profits frequently. They do so by finding a huge movement and riding it relentlessly until the market itself, through clear, unmistakable signals, indicates that the trend is broken. You must sit tight. Sitting tight means enduring the natural reactions, the minor pullbacks, the temporary scares that are inherent to every major market move. The market moves forward, consolidates, and then moves forward again. If you are impatient, you sell during the consolidation phase. You jump out and then watch, paralyzed, as the major trend resumes without you. Inactivity, in this sense, means the refusal to interfere with a winning position. It means the refusal to fiddle, to tinker, to take profits too early, or to second-guess a trend that is clearly established. Allow the market to do the work. Your work was the analysis and the entry. The market's work is the profit generation. Do not interrupt the labor. The hardest thing for the human psyche is watching a substantial paper profit fluctuate. You must become emotionally dead to the fluctuations of the ticker tape once you are in a good position. If the basic conditions that drove the price upward, the major economic forces, the earnings reports, the industry trends, have not fundamentally changed, you have absolutely no reason to sell. The inability to sit tight transforms a potential fortune into a trivial income. The discipline of inactivity during a winning trade is the difference between making quick money and making serious, lasting wealth. You must wait for the final payoff. Do not exit until the clock has truly run out. To enforce this discipline, you must construct a rigid confirmation signal barrier. Impatience often manifests as jumping the gun. The speculator sees the first small indication that his theory might be correct, a slight increase in volume, a single day's price rise, and he enters immediately. This is recklessness, not confidence. You must build a concrete filter that requires multiple, distinct points of confirmation before action is taken. For example, your system might demand not just price movement, but confirming volume. It might demand that a stock break a critical pivot point and then hold that point for 3 subsequent trading days. It might require confirmation from psychological indicators, a clear change in the general sentiment reported by the financial press. The time that elapses between the first signal, the initial suspicion that a great move is coming, and the final confirmation is the crucible of discipline. The market provides false starts constantly. It sets up traps for the eager and the impulsive. It wants you to deploy your capital at the moment of highest uncertainty so that you are battered out before the real trend begins. If you jump the gun on the first signal, you are engaging in impulsive trading. You are speculating on a hope, not on demonstrable evidence. The confirmation barrier requires you to wait for the evidence to become overwhelming. It must be so clear that your entry is practically a foregone conclusion, not a risky guess. A speculator should feel that he is late, not early. If you feel slightly late, it means the trend is already established and has confirmed itself. If you feel early, you are gambling on a premonition. Rigidly applying a three-step confirmation filter, a price confirmation, a time confirmation, and a volume confirmation will dramatically reduce the frequency of your entries and dramatically increase their efficacy. Waiting for the barrier to be crossed is the ultimate test of your conviction and your emotional control. If you cannot wait for your own system's rules to be fulfilled, you do not have a system. You have a wish list. You must recognize that the power of boredom is one of the most insidious enemies of the disciplined speculator. Boredom is the catalyst for the small bet trap. When you are correctly practicing inactivity, your life as a speculator will often feel dull. There will be long stretches of quiet observation where nothing meaningful happens. You are merely charting and waiting. This quietness assaults the ego. The speculator who derives satisfaction from constant activity interprets quietness as failure or wasted time. Boredom encourages experimentation. It makes you feel restless. It urges you to try a small bet on an unconfirmed tip or to dabble in a stock that you normally wouldn't touch, just to create some excitement. These experimental small bets erode capital slowly but surely. Worse, they erode confidence. When these small, trivial positions inevitably lose, your faith in the market and your own methodology suffers. You have paid the market the boredom tax. You must treat your waiting period as a high-stakes discipline challenge. The challenge is not to find a trade. The challenge is to not trade. If you're feeling bored, if the itch to engage is overwhelming, you must step away from the ticker. Shut off the machine. Go for a walk. Read a history book. Engage in an activity completely divorced from the financial arena. The moment you use capital to alleviate boredom, you have violated the foundational principle of speculation. Speculation is serious business. It is not a pastime. A speculator must be fundamentally cold, calculating, and patient. He must view capital deployment as a rare, highly significant event. If you cannot conquer boredom, you will never conserve the capital necessary for the massive moves. The market has an unlimited appetite for the capital of those who must always be doing something. Your capital must be conserved like a general's reserve force. It is deployed only when the strategic advantage is overwhelming. Understand the cyclical nature of opportunity. This realization is crucial to maintaining patient inactivity. Major, trend-following opportunities are not daily, weekly, or even monthly occurrences. They are cyclical events tied to economic tides, industrial revolutions, and monetary conditions. The speculators who construct the monumental fortunes, the men who move from moderate wealth to massive wealth, are those who have the genuine patience to conserve their ammunition for months or even years. They deploy maximum force only when the genuine large opportunity presents itself. It is sheer folly to expect a spectacular speculative opportunity every morning. The market operates in distinct phases: accumulation, markup, the trend, distribution, and markdown. The time dedicated to accumulation and distribution, the confusing phases where true direction is unclear, can consume the vast majority of calendar time. The true profit phase, the markup, is the shortest, most intense period. If you are busy trading during the accumulation phase, you are constantly whipsawed. You are paying for the privilege of watching large forces battle for control. The disciplined speculator understands the cycle. He recognizes when the market is in the fighting phase. He waits for the winner to emerge and establish dominance. Then, and only then, does he commit. You must visualize your capital not as a general fund, but as a limited number of powerful strikes. If you use those strikes casually, you will have nothing left for the main event. This cyclical understanding removes the pressure of feeling obligated to participate. If the cycle is not in the markup phase, the job is simply preparation and preservation. The expectation of perpetual profit is childish. The market ensures that the greatest opportunities are rare, precisely because rarity necessitates patience, a quality the masses lack. Your inactivity during the lean times ensures that you are financially and psychologically optimized for the feast when it arrives. Finally, you must master the psychological barrier of FOMO, the fear of missing out. This fear is the immediate psychological consequence of successful inactivity. While you are waiting, while you are adhering to your rigid confirmation barriers, you will inevitably watch other speculators make profitable trades. You will hear the boasting of the men who got in early. You will see prices move upward without your participation. This creates immense emotional pressure. You feel the deep regret of missed opportunity. You must train your mind to distinguish between two radically different concepts, paper loss and real loss. A missed opportunity, a trade that went well without your involvement, is merely a paper loss. It is capital you never had, and therefore you cannot truly lose it. It is an emotional inconvenience, nothing more. An impatient, poorly executed trade, a position taken out of fear of missing the move, results in a real, tangible capital loss. This loss depletes your war chest. It requires you to make back the lost money before you can even begin to profit. I learned that missed profit is far less damaging to the speculator than actual loss. The discipline of inactivity protects you from the emotional tyranny of watching others profit during times when your system demands stillness. Your system demands stillness because those profits are often fleeting based on shallow analysis or simply noise that will be reversed. The market will always offer a new chance. Always. If you miss one spectacular move, another will follow, assuming you have preserved your capital and your patience. If you rush in and lose your capital, you may find yourself sitting on the sidelines, truly inactive, not by choice but by financial necessity when the next great move begins. Do not allow the success of others to dictate your risk. Your only job is to follow your rules. If the rule says wait, then the market could double without you, and you still wait. The speculator who masters the wait knows that the most expensive emotion in the market is regret driven by impatience. Avoid it. Preserve your capital and wait for the signal that is meant for you and for your system. Inactivity is not laziness. It is not idleness. It is the ultimate form of strategic intelligence and capital defense. When the market offers no clear edge, your greatest victory is not a 10-point gain. It is the conservation of your cash and the mastery of your patience. The market is designed, structurally and psychologically, to reward the disciplined, cold observer and to utterly destroy the emotional, busy participant. Master the wait. Preserve your ammunition. Defend your mind. Master the wait, and you master the trade. You can watch hundreds of hours of content and read dozens of books about the market. You are filling yourself with knowledge, which is excellent. But knowledge alone won't make everyone rich, because not everyone possesses the right foundation. The market is the same for everyone. The only difference lies in the mindset. You can have a perfect trading system, but if you lack discipline and an understanding of your own psychology, that system is worth nothing. I often see a recurring theme in your comments. It is easy to talk about strategy in theory, but when it comes to the actual trade, many struggle with emotions. For those who want to focus on discipline, patience, and self-discovery within trading, I have created a new channel called The Stoic Trader. I believe it will help many of you bridge these gaps. So if you think this kind of content would be useful to you, go ahead and check it out. The link is, as always, in the description below.